and thank you to KRB for their unwavering support since quite a few years in terms of M&A Club sponsorship and gala participation. Suzanne is a member of our board, and I'll introduce her in a second. Just to tell you a few things about the club. We're at 19 clubs, of course, across Canada. When we get back to live meetings, we will be opening a New York City club, first chapter, probably in October, and everybody will be notified, of course, what the date and location is of that. It's coming up. We're interested in receiving more nominations for the gala, the M&A Awards Gala for Quebec. At least one of the parties has to be based in Quebec. So if it's an Alberta or an Ontario deal or whatever, as long as one party or the advisor, whoever, is in Quebec, it qualifies. And it's been very successful, this M&A Awards Gala, since 2017. We started off with a bang, and it's continued. Our actually guest of honor, Président d'honneur, is the #2 person at the Fonds FTQ, which is a labor fund in Quebec of about $14 or $15 billion. They're involved in over 2,700 companies in Quebec as investors, either minority or majority, usually minority. We had Jenny Beck originally, who is now the #1 person there. Who's a wonderful lady, as our guest of honor, but she's passed the baton, as it were, to the person who replaced her. So we're very pleased about that. This is the 94th webinar, and we will continue, assuming we get back to live meetings, whenever that is, we will still continue webinars because there's a national interest. And as you know, Lorene will be sending out the list of attendees to everyone, so everybody's connecting. We also do our M&A Club Connect, which is a virtual, which Zoom call a meeting as opposed to a webinar once a month. So if you're interested in pitching your deal, this is for members only. Let us know, and you can sign in. Lorene will be having the the list of upcoming webinars sent to you regularly. You see on your screen Jane Webster, who's a new member of our marketing, and I'll have more to say about Jane as the weeks go on. And in the meantime, I'm very happy to present Suzanne, who, as I said, is a member of our board. She's a partner at KRB. She's a longstanding lawyer in mediation and corporate law. And we think very highly of Suzanne. That's why we asked her to be on the board. And we're very pleased with her participation. She will introduce Maxime.
Hi, everyone. Welcome. Thank you for joining us today. It's my pleasure to introduce my colleague, Maxime. I will talk about KRB a little bit. KRB is a transactional firm which specializes in financing real estate and especially M&A. Maxime has over 20 years of experience in M&A. He's worked on transactions involving many of Quebec's largest players, both in Canadian and cross-border transactions. Maxime has held several leadership positions with the Canadian Bar Association, including as chair of the business law section, Quebec division, and also with the business law section of the American Bar Association. Maxime is repeatedly recognized as a leader in mergers and acquisitions by various organizations such as Best Lawyers and Legal 500 Canada. He's also taught business law at the Bar School of Quebec for about 10 years. And last but not least, he's been named as a fellow of the American Bar Association Foundation. That being said, I will pass on to Maxime.
Thank you, Suzanne. Thank you for these nice little lies, and thank you as well to the M&A Club for having me again for this encore presentation about financial or about purchase agreements and provisions that that M&A professionals sometimes don't read, but that might be of interest to you. Welcome everyone. This presentation is made for, or was designed with the idea of talking about provisions that M&A professionals sometimes don't read. You're very good, whether you're an accountant, a financial advisor, or another type of M&A professionals, you're very good at reading financial provisions. But sometimes there are other sections in the agreement that could be of interest to you, and this is what we're going to talk about. So if you're a lawyer, perhaps this will sound slightly basic, but hopefully you can get something out of it as well. And of course, if you have questions, don't hesitate to raise your hand at any point. I'll try to answer as many as I can as we go along. So just to start, so that we can just be on the same page as to what is a purchase agreement. You've seen purchase agreements. Usually they're divided in about 6 sections, more or less. We start with the definitions, then and that you read those definitions very well, especially when it comes to the definition of EBITDA, of working capital, of net debt, and you provide valuable comments on that. There are other definitions that are more legal that we're going to talk about, one in particular, that really shifts the balance of risk between, or the burden between the purchaser and the seller. And so we're going to talk about that a bit later. And then there's the main, or the most important section of the agreement that you also spend a lot of time reading, the purchase and sale section, where we determine what we buy. Is it shares or assets? We determine when we're going to buy. Is it today or once conditions are met? How much? The purchase price, which is key. How the purchase price is determined. Is this a fixed amount that is paid 100% at the time of closing, or is there a balance of sale, an escrow, an earnout, or other types of delayed payment? So all that is clarified in how is the purchase price adjusted as well, is set out in usually section 2 of the agreement. And that also you pay a lot of attention to, and it's great because it's obviously the most important section of the agreement. Then the remainder of the agreement is more legal. The longest section of the agreement is the reps and warranties, where the seller will confirm to the purchaser that everything is okay with the company that is being purchased. And if it's not okay, then the seller will explain or disclose what is not perfect about the company. Then after that, there's the covenants section, whether pre or post closing, depending on the type of the agreement we have. We won't talk about covenants today. And then there's the indemnification, which is probably the second most important section after the purchase and sale section. And we're going to talk a lot about the indemnification section later on this morning, because there's a lot of things in there that are important for you and for your clients who are buying or selling a business. And finally, we have the typical boilerplate provisions that we won't spend too much time on today. So let's dive in and talk about specific provisions that could be of interest to you and your clients. We're going to start with the definition of knowledge. So in the definition section, usually we will have, or we will determine, what does the knowledge of the vendor mean? And for the vendor or the seller, the initial reaction is to say, well, my knowledge is what I know. I know what I know, and what I don't know, I can't tell you. Well, it's a bit more complicated than that. As a buyer, you typically won't satisfy yourself with a seller saying, well, I know what I know, and if I close my eyes and I just forget something, or I don't pay attention to anything, well, too bad for you. The buyer will expect a bit more, and in its most, I would say, comprehensive version, this definition can be as broad as what you have in the second paragraph, which is that the seller the knowledge of the vendor will mean the actual knowledge of the seller, of course, or the knowledge of the shareholders of the corporation, the directors, the officers, the employees, and or the knowledge that such persons should have if they had done due inquiry. So the buyer is saying, I don't really care what you actually know. What I care about is what you should know if you have done sufficient inquiry, if you have done sufficient due diligence about your own company. And so if you don't know, you can't hide behind the fact that you didn't know, unless you can demonstrate that you have done enough to determine whether a fact was true or not. So as you can see, the burden for the vendor in the second paragraph is much higher than it is in the first paragraph. So usually we're going to find some middle ground. It won't be just the actual knowledge of the vendor, but the vendor will say, listen, my shareholders don't know anything about the company. I'm not going to ask every employee what they know. So maybe we could say that it is the knowledge that I'm aware of and the knowledge of the CEO and the CFO, for instance. That's one way to tone this down a bit. Or we will say that, okay, so it's the knowledge, my knowledge and the knowledge of the CFO and the CEO after reasonable inquiry. So due inquiry, I'm not sure exactly what it means. I'm going to do what is reasonable, but I'm not going to go crazy on calling my suppliers and my clients to see if they know some things that I should know. So I'm going to do what is reasonable. Sometimes we're going to say that the knowledge is limited to internal inquiry. So again, to limit who I'm going to speak to as the vendor, I'm going to limit myself to speaking to people within my organization. I'm not going to go out and speak to governmental authorities if they know something about my business that I don't know. I'm not going to, again, talk to suppliers or customers, or I'm going to stay within the company. So as you can see, and the definition of knowledge is important because later in the reps and warranties, when the seller says everything is okay except for X, Y, Z, many of those reps are given to the knowledge of the vendor. So the vendor will say, I'm not aware of, there are no current third-party claims, and to my knowledge, there are no threatened third-party claims. Or to my knowledge, there are no threatened governmental inquiries or notices of assessment that are coming. To my knowledge, there are none, but maybe there are. So again, depending on the definition of knowledge that you have, you will have some reps that can be true or that can be not true, depending on the intensity of the knowledge qualifier that you're going to have. So, so this is something to bear in mind and to bring to the attention of your client, whether you're representing a purchaser or a seller, to make sure they understand how well they are protected or how high is the burden that they are under or subject to if they are selling. Let's move on to the reps and warranties. I want to talk about two particular reps and warranties that are in most purchase agreements and that are quite important for the future liability of the seller. In most purchase agreements, you will have a section that talks about existing liabilities, about the fact that they are duly recorded in the financial statements and that the financial statements are true in all due respect. And that is pretty standard and common and normal. However, also in most purchase agreements, the purchaser will say, okay, so you have disclosed your liabilities in your financial statements, that's fine, but I want to know that there are no other undisclosed liabilities that haven't been disclosed in this agreement or in your financial statements. So in the first version, which is pretty broad, you will see that we ask the vendor to confirm that there is no liability, indebtedness, of any nature whatsoever, even known or unknown, other than those that are in the financial statements. As a seller, as you can imagine, it's very hard to give that rep, because how can you know what you don't know? So by asking the seller to confirm that they don't know, or that they are not aware of unknown liabilities, is a very, very high burden that is quite difficult to meet. So, but the purchaser will say, listen, if there is something coming that I'm not aware of, I want you to tell me, or else I want to be indemnified. So the first version that you see is very pro-purchaser, and imposes a very high burden on the seller. If you look at the second paragraph, then you have the same rep, but drafted more in a more balanced way and more in favor of the seller. So we're going to say, the seller will say, listen, to my knowledge, we just talked about knowledge, except as I've told you elsewhere in this agreement, there are no material liabilities. So if it's not important, I'm not going to have to tell you, or obligations, which are required to be accounted for on the balance sheet in accordance with GAAP or ASPE. So if I'm not required to put it on my balance sheet, then it means it's not a true liability yet, and therefore I don't have to tell you at the moment, except for those that have been incurred in the ordinary course or recorded in the financial statements. And also, I'm going to tell you only to the extent that those liabilities are not material. If they are material, then I'm going to tell you, but if they're not, I don't have to tell you. So from the seller's perspective, this is a much more palatable rep to give. Most sellers will not have an issue with that rep. So again, usually we will try to, if we're buying, we're going to try to get the rep that you have in the first paragraph as is. It will be resisted by the seller. And if you're selling, we're going to try to qualify it as much as it is in the second paragraph, but the buyer will probably come back, and you're going to find some common ground to make it acceptable to both sides. Another rep that can change the burden of, or shift the liability between one party and the other, is usually the last rep that we have at the end of the rep to warranty section. It's called, most of the times, a full disclosure rep. So there, the purchaser says, listen, seller, you've been telling me for 15, 20, 25 pages that your company is okay. I've asked you a lot of things that I wanted you to confirm about every aspect of your business. However, just to be sure, I want to make sure that you confirm to me that nothing there is untrue, or you haven't admitted to tell me anything that I should have thought of, and that I should have thought to ask you. So for and then in the second sentence, we're gonna, or the purchaser will say, listen, not only that, but I want to make sure that there is nothing that hasn't been disclosed to me that could cause me or any other reasonable purchaser not to enter into the transactions contemplated by. So for the sellers or the vendors, this is a very high standard to meet, and it's very hard to know if the rep is true or not, or to determine whether the rep is true or not from the seller's perspective. Why? Because as a seller, I don't know what could make you do the deal or not do the deal. I don't know what you think is important enough, or I don't know what you would expect me to tell you. So it's a bit of a psychology clause, if I can call it this way, where you have to get into the seller's mind, the buyer's mind, and determine what is important for him. So the seller giving that rep usually won't have much comfort that it is giving a fully true rep because you don't know what the buyer thinks. So at the other end of the spectrum, the vendors will be able, however, to say that there are no statements in Article 3, which is the reps and warranties, that are not true or incorrect in all material respects as of the day he run. So as a seller, I can say, don't worry what I've told you over those 25 pages. There is nothing there that is not true or that is not correct in all material respects. That I can say. So again, we're going to negotiate between the buyer and the seller to try to find some common ground. Usually, if we work together on a deal, perhaps I will push it further than on if I'm buying. But usually, the second sentence of the first paragraph, we can get away and remove. Most buyers will agree to remove this, and then it's a question of finding some common ground where we may have some materiality or fibers to make the first paragraph more.
So I think it was pretty much done on the full disclosure rep. Again, as I mentioned, you probably won't get the first paragraph completely, and the buyer or the seller will probably not get away with just the second paragraph. We're going to try to find some compromises in between. So, okay, let's move to the indemnification, and I want to spend a fair amount of time on this one. The indemnification is the section of the agreement where we say, listen, I thought I know what I was buying. You told me during those 25 pages of reps and warranties that your company was in order. If this is not true, I want to get indemnified. I want to be compensated. I want a portion of my money back to be made whole for the losses I suffer because your reps and warranties were not true. So, and the seller will say, fine, I'm gonna, if my reps are not true, I will indemnify you. However, there will be some limits on my obligation to indemnify you. And those limits that you're probably familiar with are the first four. So we're going to say that as a seller, I will have an obligation to indemnify the buyer for a certain period of time only. That period of time varies from 12 to 24 months. I would say recently I've seen closer to 12, 15 than 24, but anywhere within 1 to 2 years is pretty normal. More than 2 is quite exceptional. And then the seller will say, listen, I will indemnify you, but there has to be a limit on that. There has to be a cap on my obligation to indemnify you. I won't give you the full purchase price back. I need to know that there's at least a portion of the purchase price I'm receiving from you that I can use right away, either to start a new business or to buy a boat or to do whatever I want with my money. And so I need to be able to sleep at night and know that at least a portion of what I'm receiving is secure. And therefore, I won't indemnify you for more than 25% of the purchase price, or 30%, or 20. Again, these are just guidelines. Sometimes in larger transactions, it can be less than 20%. In US deals, it's quite frequent to be less than 20%. In Canada, 20 to 50 is, in mid-market deals, is pretty common. We rarely see more than 50. It has to be very specific circumstances to go above 50. And then the third limitation that the seller will ask, the seller will say, I will indemnify you, but I don't want to argue about minor details. I don't want to argue about things that are not important. And therefore, let's have a basket of a certain percentage of the purchase price where we're going to put all the small claims. And if we reach that basket, the threshold of the basket, whether it's 0.5% of the purchase price or more or less, if we reach that threshold, then I will indemnify you. Usually the buyer will agree to this because it's more convenient. And the two questions that will be discussed will be first, the amount of the basket, and two, whether it's a true basket or if it's a deductible. What is the difference? In one case, it means that once the threshold is met, in the case of a basket, then the seller has the obligation to indemnify the buyer from the first dollar. So let's say the 0.5% equals $50,000, just for our case. If we have claims for $51,000, then the seller will have to indemnify the buyer for the full $51,000. If it's a deductible, then once we reach the $50,000 and we're at 51, the seller's obligation is only to indemnify the buyer for that $1,000 that exceed the threshold agreed upon. So that's a big difference, because it's almost having like a double basket, because very few purchaser will seek indemnification for $1,000, and therefore you have reached the threshold of 50, but you're kind of saying, listen, I'm not gonna start, chasing my seller for $1,000, so I'm gonna eat it up anyway. So for the buyer, it's a bit of a challenging situation to be in, but we see both. It's a game of negotiation. The fourth limitation that you see is a de minimis, which is essentially a threshold on the amount of each claim. It's usually in larger transactions. In smaller, we don't see that very often. But the seller will say, listen, there's a basket of, in that case, let's say there's a basket of $250,000, and we're going to put the small claims there, but we're not going to put claims that are less than, let's say, $2,500. I don't even want to hear about $1,000 claim. If it's not $2,500, we're not even putting it in the basket. We're just ignoring the claim. So again, in larger transactions, that's convenient because, again, you don't want to argue for every little penny or every little dollar. So we see that, but not always, less often. So now, as an advisor to the sellers or to a seller, I have heard a lot of times advisors suggesting that, well, listen, we got you a good survival, a good cap, a good basket, so therefore you can sleep at night. 80% of your purchase price is off the hook. Is that true? Not exactly, because there are some specific indemnities, and that's the last point on this slide. What are specific indemnities? Well, usually, as I mentioned, we're going to say the seller will indemnify the buyer for breaches of reps and warranties. However, then we're going to also say the seller will indemnify the buyer for breaches of certain specific elements. And what are these elements? These are elements that the buyer will say, listen, these are so important for me that if they are not true, there is no basket, there is no cap, there is no survival. I want to be indemnified from the first dollar and for whatever the time it takes for me to find those losses or damages. And so what are they? Usually we're going to have a specific indemnity for fundamental reps and warranties. What are the fundamental reps and warranties? Usually ownership of the shares. So if the seller doesn't own the shares that they're selling, then there is no cap, there is no basket. I can get my full money back. Corporate existence. So if the seller sells the shares of a company that doesn't exist, the buyer should get full indemnification and not be limited in any way whatsoever. So reps that are so important that they go to the fundamental nature of the deal are usually excluded. So from the cap, basket, and survival. So it's important for the seller to understand that the basket doesn't cover, or that those limitations don't cover everything. The second one that is the classic one is specific indemnity is taxes. Usually buyer will say, I don't care if the reps are true or not true. I won't pay for your taxes. If you didn't pay your taxes in the past, this is for you to pay. This is not for me. And I don't want to start figuring out whether your reps were true or not true, whether I receive a notice of assessment after 18 months or 19 months. No, if you haven't paid your taxes, you're going to pay from the first dollar no matter what. These two specific indemnities are largely common and not really challenged most of the times. But there are others that can be very, well, that will limit a lot or remove a lot of the limitations that we just talked about. For instance, some buyers will say, listen, there are some third-party claims that the litigation that are outstanding right now. I don't want to pay for that. So this is, you are being sued because of things you did in the past. I'm not assuming this, and you're going to pay for everything related to those third-party claims. That many times will be accepted. However, some purchasers will say, and if there are new claims for events that relate to the past, I want to be indemnified from the first dollar as well. So then your specific indemnity is not only those existing litigation or third-party claims, but those eventual or potential third-party claims that can come in the future. Another one that we see, so that's a much higher burden for the seller, because anything that comes after, irrespective of time, they will have to support, no matter what, as long as it relates to events that occurred prior to the closing date. Another one that we see more and more is the buyer will say, you're going to have to indemnify me for any debt that was not accounted for in the closing financial statements. So in many deals, and just a little parenthesis, most of our deals are what we call cash-free, debt-free. So the buyer assumes that there are no debt at the time of closing, and any debt that remains in the company reduces the purchase price, the agreed upon purchase price accordingly. So, and that is determined in the closing financial statements that are prepared at the time of closing. So the buyer will say, if there are debt that we didn't capture at the time of the preparation of the closing financial statements that come up afterwards, then you're going to indemnify me for that. So that's a very high burden for a seller, because with that specific indemnification, the seller has to understand that anything that comes up after closing that was not in the closing financial statements is not subject to the deductible, is not subject to the cap, and is not subject to the survival. So it could be that something comes up in 3 years and you have to compensate the buyer for that. So as you can, from a buyer's perspective, that's great. But as you can see from a seller who thought that his 80% of the purchase price was secure, suddenly the seller is in a much weaker position, and he has to think carefully about how comfortable he is with giving such a level of indemnification. So it's very important to understand when you read the indemnification section that anything other than the indemnification related to a breach of reps and warranties is not subject to the survival cap or basket, or de minimis if there's one. So that's not always easy to read, or that's not always easy to catch. So it's very important to understand that. A few other things. I see that time is flying. few other things I want to talk about just so you're aware. Uh, Provisions that you find in the identification section. One is sandbagging. Um, Sandbagging is a provision that says that the purchaser will be entitled to make a claim even if the purchaser is aware of the claim at the time of closing and hasn't disclosed that claim to the seller. So seller will be uncomfortable with this provision saying, listen, if you're aware of a problem that you found during your due diligence, let me know now so we can deal with it. And if there's a purchase price adjustment to make, let's make it. But I don't want you to sue me the day after closing for something you knew the day before closing, essentially. And however, some sellers will do the opposite. They will say, listen, if you are aware of something and you don't tell me at the time of closing, you buyer will not have the right to be indemnified. That's what you see in the second paragraph. So for a buyer to say something, to make such a, to have such a broad statement is many times quite challenging and makes most buyer quite uncomfortable, especially if the buyer is a large organization that has a large team of advisors and internal resources doing due diligence. It may be that the buyer as an entity knows something, but that the principals, those who make the purchase decision when it has to be made, are not aware, or maybe they know the facts, but they're not realizing that could constitute a claim later on. So buyers will resist as much as they can having a clause like that. I will say that, and then it becomes important to know if you don't have neither of these clauses, it's important to know in your jurisdiction what is the state of the law. So if you're silent on this, for instance, in the province of Quebec, a buyer, if there's nothing in the agreement, in most cases, the buyer will not be able to make a claim if the buyer is aware of the claim at the time of closing. So if you're silent in your agreement, then you're getting pretty close to the first paragraph. So just being silent is usually not enough because then it's common law that will apply, depending on your jurisdiction, depending on the province where you are. It can be different from one to the other. And quickly, I will talk about materiality scrape. Just so you're aware, we don't see it very often in Quebec, at least. More and more in cross-border transactions. It's a provision that says that from the buyer's perspective, I will agree to let the seller tell me that its business is okay, materially okay, in all material respect, that there are no material claims or other qualifiers of that nature, but for the purpose of being indemnified, I won't take those qualifiers into account. So meaning that even though okay, I had to close your deal because the rep was true with those materiality qualifiers. However, when it gets time to be indemnified, we're calculating the damages as if there were none. So this is a U.S. concept that is coming here slowly to Canada. I want you to be aware of it because usually concepts of that nature that are introduced in the States become standard in Canada within a few years after. So you can expect to see that more and more. Okay, good 45 minutes. Just a few words. Other things that you should look for are, if you're representing the sellers, are the sellers solidarity or jointly and severally liable. That means that as a buyer, can you sue one seller for the full amount of a claim, or you need to sue each seller for their own portion of the claim? It makes a big difference in the ability of the buyer to be indemnified. And on the seller's side, the sellers don't want to be responsible for their other sellers' mistakes or breaches, and therefore they don't want to be jointly and several. So That's something to look for and to understand early in the process, because it has a big difference. It makes a big difference as to the potential to be indemnified, and as the seller on the indemnification obligation. Same if you're selling from a corporate shareholder, will you be asking for personal guarantees of that shareholder, so you can get to the actual amount held by a person and not just by a corporation. That's also a very important aspect of a purchase agreement that will change a lot the level of potential obligation of the seller, and conversely, the ability of the buyer to get indemnified. So I'm going to stop there. Any questions before we leave?
So just a quick reminder for your question, please write your question in the chat or raise your hand and I will turn on your mic.
Maxime, I'd like to ask a question.
Sure.
No, you can hear me?
Very well.
Normally, I think the lawyers take the LOI, or in the LOI, it says this LOI will become an integral part of the purchase agreement. So a question, do you take it as it is, or is it subject to change if there's things in due diligence, or even the price that changes after due diligence? Or do you take it as it is and just insert it there? Or is it an attachment? I've seen different things and I just wondered how you do it.
Yeah, so in most cases, we will say the LOI is a non-binding document. If it's an offer, then it's different. But if it's an LOI that is non-binding, usually we're going to say it's there to give, the large, the bigger picture, the main items of the deal. However, at the time of closing, the LOI terminates and we no longer refer to it. We just refer to what we have in the purchase agreement. I would say that in most, if at least 3/4 of our deals, we have the LOI terminated at the time of closing. If the LOI is more an offer or a binding LOI, then in many cases it will survive. And in that case, yes, it will be either attached or at least referred to and be part of the closing document. But yeah, I would say the big trend is to have the LOI terminated if it's a non-binding LOI.
So most are non-binding. Yeah.
Yes. Yes.
Okay. If there are no other questions, I just wanted to ask you about reps and warranties. Are you seeing more and more reps and warranties insurance being attached to deals? And is there a minimum amount? Usually it's a $15 million or $20 million deal. Otherwise it's too expensive. Or I don't know what the threshold is, but I assume on a $4 or $8 million deal, it's just too expensive.
Yeah, so you're right. I would say now brokers are more and more aggressive, and they will agree to work on, I would say 15, even sometimes a bit lower than $15 million deals. But economically, it's becoming harder and harder to justify as you get into the low tens or below 10 as a purchase price. I would say, yeah, below 15, it's pretty rare.
Sharina from Roynet has a question. Lorene, maybe you want to read the question from Sharina?
Sure. Can you repeat? So is no cap with respect to pre-close tax matter and pre-close legal claim is generally market?
So no cap with respect to pre-close taxes, that is definitely market. It is very rare that a buyer will agree to cap its right to get indemnified for the seller's taxes. and legal claims, so that is much more heavily negotiated. So for existing claims, many times there will not be a cap. But for potential claims, sellers find that quite aggressively, and I wouldn't say that it's standard. But buyers will try many times to have that in.
Thanks. And we have a second question from Sherina as well. Materiality scrape. What is the practical implication given that most deals have baskets and minimum amounts?
Yeah. So the implication is that there are a lot more. There will be a lot more breaches of reps and warranties if you exclude the qualifiers from those reps and warranties. So you will get to your basket much faster if you remove the qualifiers, if you have the scrape, than if you don't. So yes, you still have your basket, but you will get to the threshold much faster if you remove the qualifiers from your analysis of whether a rep is true or not. I hope that's clear.
And we have one more question. Indemnity have expiration dates?
Excuse me, can you? I didn't see this one.
So the question is, and do indemnity have expiration dates?
Okay. Yes. So in most cases, the expiration is what we call the survival. So it's how long will the reps survive, and therefore how long does the purchaser have to claim indemnification. I would say, well, according to the stats and what we see, it's usually between 1 and 2 years. Most of the times, I would say we get closer to 18 months, 15, 18 months than 2 years, but we see between 1 and 2. Rarely will the seller agree to more than 2. That's pretty much the longest that we will see.
Thank you, Maxime. There is no more question.
Yeah, Maxime, I'd like to ask you, in your experience of 2017, 18, 19, of closing deals or getting deals closed, hopefully.
Yeah.
In 2020, we're told that a lot of transactions happened and a lot of transactions were about to happen, but everything was done, but they just couldn't write a check. And so the deals actually didn't close. But again, we hear about a lot of deals that did close. Were you able, or your clients able, to actually close a significant number of transactions in 2020?
So let's say before, after COVID, so up until March, it was going very well. And then for, I think it's a general, that's pretty much what happened for everyone. For a few months, as of March, nothing happened. No deals closed, or very few in April, May, and then somehow in June, the activity resumed. And to be honest, to our surprise, because we were attending webinars like these in March and April, and very sophisticated people were saying, you're going to have to be patient. It's going to be a challenging time ahead for M&A. But the activity resumed pretty fast, and the second part of 2020 was very good, and 2021 is amazing for most people in the M&A world, I would say. Right now, it's the activity is quite spectacular. So yes, we were able to close deals in the second part of 2020, and again this year without any problem.
That's great. Great to hear. Lorene, do you want to read any other questions?
Yes, so we have one more question. In past years, it was difficult to find data on RWI claims in Canada, given the novelty of the product. Are you seeing more claims now? If so, are insurers paying out?
Yeah. Most brokers now have pretty good data because there are more and more deals that are insured in Canada. So if you speak to insurer brokers, they can give you pretty detailed stats about the state of the market. I would say in my case, that's personal experience. I don't think at KRB either. We didn't have, luckily enough, we didn't have to make any claims under our deals that were insured. But from what I hear in other firms, insurers are paying pretty smoothly. It doesn't seem to be a big issue in Canada. They are, when they have to, they pay. That's what I've heard, but I've personally never been involved in that process, luckily enough.
Lorene, you have.
I have no more question.
You have one more question from Sharina?
No, it's done. I've just give the question.
Okay, I guess this is a wrap, as they say. Maxime, thank you very much for this. It's most interesting, most important for us to know when we, of course, are facing our clients and they're asking us for information on how this whole thing works, because generally, in my experience, they know a lot about their business, their suppliers, their clients, their industry, their global or Canadian position, but they don't know very much about selling their business, generally speaking.
You're correct.
And so we have to know this stuff, and thank you very much. I hope it leads to more business for you and more good business contacts for you and for KRB. Thank you very much. Next week, we'll have a continuation of our webinars. It'll be number 95. In October 6th, Angelo Noce from Blake's, who's a senior partner with Blake's, will give his annual M&A review of all kinds of M&A metrics and information about Canadian deals. And also he reviews, to some extent, the ABA, the American Bar Association stats that are available that he, I believe, contributes to. So that's a very interesting one, October 6th, but there's other ones coming up. So thank you all for attending this morning, and hoping that everyone gets in nominations. If you don't nominate, you can't win. If you nominate, obviously the more deals you nominate, the more likely you are to win an award at the M&A Awards Gala, November 18th at the Windsor. So we hope to see you all there, if not before. So take care, and thank you, Maxime, for taking your time this morning again.
Well, thank you for having me. It was a pleasure.
Okay, we'll talk to you soon. Be safe, everyone.
Thank you.